Hello and welcome to BloombergQuint. We're joining in today to get you the latest set of announcements that have come in from the government to help us through this COVID-19 crisis. I say latest because the finance minister said that we're going to get many doses of it. So this is not the complete package, but this is a part of it. Joining us to talk us through some of the measures, and I'll just briefly detail them in a minute, is Rahul Bajoria, Chief India Economist at Barclays for the big picture. Abizer Diwanji joins us for the financial sector measures, particularly the NBFC and the HFC measures. And Mahesh Misra, Chief Executive Officer of the Indian Mortgage Guarantee Corp, joins us to talk us through how these guarantee processes have worked in India and how effective they can be. So we'll get to all of those very briefly. The three sort of big announcements that came in. One was targeted at SMEs, and change in definition for SMEs, also collateral-free loans for SMEs backed by the government. There were measures for the NBFC sector, which has been liquidity starved. Those have come via two separate liquidity facilities, one fully guaranteed, one partially guaranteed. And the third major step, which we may not discuss in detail in this conversation, is the relief being provided to DISCOMs. Yet another relief. But let me start with you, Rahul, and get a sense of the big picture. I think for a while it has been said that there is relief that needs to be targeted via first cash transfers to the most vulnerable people and then via some sort of facility to the most vulnerable corporations. This sort of fits in the second bucket.
Yeah, so thanks, Ira. So I think the biggest change that's coming about here is that on the MSME side, there seems to be an initiative to try and redefine the sector and the way we sort of the government interacts with them. I think the increase in the size definition seems very, very important. And at the same time, I think there'll be a lot of effort which should go into sort of collecting information about these companies and track their progress, as we provide support to them. In terms of, whether these large-scale bank guarantees, credit guarantees would work in the long term, I don't know. I think it depends on what the operational framework looks like. But from a macroeconomic perspective, out of the 20 trillion, our initial estimate was that the government had already accounted for close to about 9.5 trillion INR. I think looking at the numbers that were presented today, we probably have seen about 6 trillion of measures being outlined, and another 6.7 trillion are pending. Given the 5.4 trillion amount of measures which were listed from the RBI side and the first fiscal package, which was close to about 1.9 trillion as well. So there's another 6.7 trillion of money to play with. The real bottom line, though, on the fiscal front, as far as the on-balance sheet spending is concerned, by our estimates, it will come to about 555 billion INR. And there's probably another 1.35 trillion INR of spending, so another close to about 70 basis points of GDP that the government can list out on balance sheet for the rest of the year.
Okay, Rahul, sorry, I'm going to stay with you for one follow-up question. So we are assuming that all the LTROs, etc., that the RBI announced are all part of this 20 lakh crore package. How do you bucket that? That is not fiscal support. That is liquidity, some of which happens in normal course of business. So, if I can just say, it's slightly disingenuous to park it as a fiscal package.
Well, I think on the definition side, we can. I agree with you that it is not exactly a fiscal support, but liquidity provided in these times is also quite critical, probably more than just injection of equity, because there is no growth capital really required in the current circumstances. I think that's a problem to be addressed in 3 or 6 months' time. So liquidity, in a way, is support, and the government has chosen to kind of add that in to the numbers, but then it is only about a fourth of the total package, right? It is not the whole thing. So if we can get these credit guarantee schemes, the loan moratoriums of the 3 lakh crores of additional loan injections, I think it will be a very, very punchy, very powerful way of doing it. The only question in my mind is, do we have the operational framework, correctly in place, without which a lot of these things could be stillborn.
Okay, now which allows you to go to Abizer and to Mahesh. Abizer, there was some expectation that we'll get a bad bank today. We didn't get that, but okay, at least the NBFC side seems to have gotten a fair amount of relief. What did you make of these measures?
So on the NBFC side, I frankly think that it does not provide enough on the liquidity support for NBFCs. Clearly, 30,000 crores is too small, or even 30 plus the 45. 75,000 crores is too small given the size of the problem. NBFCs are 27 lakh crores in terms of lending. 19 lakh crores of it actually comes out of the capital markets, which is unlikely to get moratorium or refinanced. While the asset side, 100% of will get the moratorium. Banks are not giving fresh money to NBFCs. So from the existing legacy balance sheet of NBFCs, I don't think there is much liquidity support. Having said that, I think the 3 lakh crore transmission, a lot of it will happen through NBFCs because they are primarily the lenders to the MSME sector, and that's the good part. Because what will also happen is, say, just take the numbers that the government has given. If you take 25 crore outstanding, on which you get a 20% support, assuming you have a 100 crore turnover, you basically get a 5 crore incremental support. And if you take 20% of the NBFC's book and say, assuming all of them need support, or 20% need support, if you take a NBFC SME book of, say, out of the 27 lakh crores, say 10 lakh crores is an SME book, you will get 20% support, which is roughly 2 lakh crores, will flow through the NBFC sector. That will be eligible for refinancing with the banks. So the NBFCs can actually originate and quickly refinance it with the banks because this is government-backed paper.
Yeah.
So that will bring a lot more liquidity into the NBFC sector to finance the legacy balance sheet, which it may need to. So I see that as a pretty good benefit. But the quickly, and of course, because they have to ramp up by 31st of October, they need to quickly get into the job of identifying corporates where they can actually extend the 20%.
Okay.
On the second scheme, which is the NBFC's 30,000 crores, which has come in, I just think it's a good enough scheme. It's better than the earlier one. The earlier one, frankly, had a significant flaw. While the NBFCs had residual maturities of 4 to 5 years, the earlier credit guarantee scheme was only a 24-month scheme. And for an NBFC origination within 24 months, there is normally no delinquency. So effectively, that guarantee meant nothing.
Yeah.
Now this 30,000 crore guarantee is now a guarantee for the full period. So effectively, I think it does deal with that issue that now banks will be comfortable lending against this government guarantee. The earlier scheme by 1 lakh crores was announced in the budget. There was not too much of an offtake because banks were not willing to refinance it.
Yeah.
I think to that extent, the 30,000 crore scheme is good, and so will the partial guarantee scheme. I think which we're talking about will the first loss guarantee loss of 20% is good. So I fundamentally think that any transmission of credit has to happen through the NBFCs, MFIs, and HFCs.
Yeah.
Because and I would have liked to see something where the first loss stays on the capital of these entities. Because then there is some responsible lending. Otherwise, the risk that we have is that everything is a pass-through. Then I don't really care.
Yeah.
So I think responsibility and lending would have come if there was some strain or some impact on the capital of an NBFC if there were developments out of this new funding.
Perhaps that would have just exacerbated or not solved the risk aversion problem. But I'll come back to you on that. But Mahesh, jump in here. You run India's only mortgage guarantee corp. Tell us how these guarantees are structured, how well the system is poised to take advantage of it. Because, for instance, in the real estate fund that the government had set up, I believe it took ages to just get the paperwork going, figuring out whose books the guarantee is going to be on. Is the system poised to work with these guarantee sort of relief programs?
So I think guarantee as a concept is what we require right now, and that is something that will kickstart many parts of the economy better than a theoretical liquidity measure would. So I think guarantees are certainly required. With regard to MSME, I think the guarantee scheme that has been announced today is very broad in nature. We will have to wait to see many other operational details. Now, one, we still do not have clarity whether this 3 lakh crores is for new facilities or is it only an enhancement over an existing facility. Second, if it is a new facility, what will be the eligibility norms that banks or NBFCs will apply? Because it is ultimately, even though it is fully backed, what is the eligibility norms that people will apply? Third, one of the biggest challenges of a guarantee scheme is that if it is for new facilities, it could very well be treated as a license to default, because many people could believe that since the lender is anyway guaranteed by the government, it could be seen as a license to default, which is why in any guarantee scheme, one of the most important operational aspects is to ensure that the recovery attempt being made on a delinquent guaranteed loan and a delinquent non-guaranteed loan is the same. Otherwise, you end up creating a massive moral hazard in terms of not putting enough recovery effort into the loan, which in turn will, in the medium term, lead to poorer credit culture for the entire borrowing system. So that's with regard to the MSME scheme. I think we will still have to get most of the details. With regard to the partial guarantee scheme, I agree with what was said earlier. If it will now be for the entire tenor of the loan, then I think it will have some value, because the 24-month guarantee has very limited value. At least in mortgages, defaults start showing up in year 4 and beyond. So a 24-month guarantee had very limited utility. A lot remains to be seen on how investment paper is defined. If it is AA, then it is still dependent on a bank's comfort with that pool or a portfolio on whether or not they want to do it. So I will still wait to see the finer print on what is being defined as the eligible pool. But in terms of what the earlier guarantee scheme was, I agree with what was said just before I spoke. It is a slightly better scheme.
Sorry, Abizer, I'm coming back to you. So how does it work? So for instance, in these partial guarantee schemes, when does the government put up the capital? Not right now. It is only if and when a default happens?
Absolutely. I don't think government is going to provide liquidity here. The government here is going to provide a first loss guarantee on 20% of the outstanding.
If I may, so guarantee schemes typically work in 2 ways. For example, in our guarantee scheme, the moment a borrower turns NPA, we provide cash flow support by paying EMIs on behalf of the borrower. But globally, there is also a practice of paying the support in one shot when there is loss crystallization. Which is why mortgage guarantee, for example, in India, it's called a guarantee because we pay real-time cash flow. Globally, in many parts of the world, it is called mortgage insurance because the payouts happen after the loss has occurred.
Okay.
So I think here, Ira, it seems to be again, as Mahesh says, one has to get into the detail to figure out. But it seems to be a loss guarantee and not an insurance. And in that situation, frankly, it will enhance the credit rating. So it also says this is meant for lowly rated NBFCs who are not able to raise money. So I presume that you are talking about triple Bs, or a slate above, who will then graduate to AA paper if there is a 20% first loss guarantee provided by the government, and then AA then effectively should be able to get credit in the market. So that I think is the concern here, is to provide liquidity through credit enhancement, and that credit enhancement will only be backstopped if there is a full loss.
Okay, Abizer, one more question to you. You said that amount-wise this is inadequate, and I get the big picture number of NBFCs, but a lot of that is in the HDFCs, the LIC housings, etc. of the world, who don't need support. I mean, they can still go to the market and raise paper, and I assume they still have bank lines. So, in the 30,000 crore fund, for instance, do you not think the A-rated kind of entities will be able to get support? In the 45,000 crore fund, they have said they'll even take unrated paper. So the MFIs will be able to get support. So while in aggregate, they may not look like a large amount, do they not serve the segment which was struggling the most is my question.
Yeah, you're right. But do believe me that a large part of the NBFC segment is struggling.
Yeah.
Leave out the HDFCs for a moment because HDFCs survive on a name. But even the more large, significantly large ones, take for example, Shriram Transport types. Fairly large kind of company, has always got money from capital markets, has always got money from banks. But since ILFS, they've got neither. And if you look at the structure of their balance sheets, I mean, I know truck finance companies which are 80% funded by banks and have not been getting funding from banks for the last 1.5 years. And now they're going to face a 2-month moratorium on their asset side. And by the way, that moratorium, though it is at their discretion, they have to give it because the underlying customer doesn't have an ability to pay. So at the end of the day, there is a huge cash flow issue. And earlier, the CP market, look at most balance sheets until last year. The CP market was a very good liquidity management tool that was available to NBFCs. That has vanished. And since Franklin Templeton, I think even the corporate bond market has vanished, except for AAA. So if you leave out the AAA, there is still a very large amount which is not going to be enough based on the current numbers.
Okay. Mahesh, is that your view as well?
Yeah, so if you look at the HDFCs and LICs of the world, now the first point we need to understand is that the housing finance market is very, very asymmetrical. The top 5 players are nearly 50% of the market, and that's become even more asymmetrical after DHFL and Indiabulls have kind of slowed down or practically finished their, have zero lending for the last couple of months or years. So the HDFCs and LICs may not need this kind of support, but in reality, I think smaller players could benefit from guarantee schemes to break this asymmetry. Because let's also realize that we have nearly 100 licensed housing finance companies, and only 5 banks plus NBFCs contribute half of the entire mortgage market. So we believe that some of the smaller players, if what we foresee happens, which is these guarantees translate into rating benefits, if these guarantees translate into risk weight benefits, if these guarantees lead to capital adequacy norms changing because this is recognized as a form of external capital support, if all of these also happen, which will need some regulatory intervention in addition to what the government has done, then I certainly see this as a welcome measure.
Okay. I'm just going to go back to Rahul and then sum up with all of you. Rahul, again, zoom out, big picture. It seems like the reliance to provide relief is still very much via the financial system. But at a time like this, when there is natural risk aversion in the system, are we picking the right mix of direct spending via government or relying on relief via the financial system?
So I think ultimately it has to be a combination of both. It cannot only be on balance sheet spending because one, the government does not have the ability to gauge credit risk across a variety of these companies, neither does the RBI, both purely from an operational perspective. And so they have to rely on the financial system. And I think the measures today will probably help relieve credit risk aversion at the margin. Now, obviously, the question becomes as to how exactly are these provisioning being done from a system perspective, both at the banking level, at the NBFC level, and at the sovereign level. And I think we will have to wait for a little bit more information. But I think this is a first good step that we have seen, and we have seen similar measures work in other countries which have had relatively weak financial systems. So Malaysia, to me, comes to my mind both during the 98 financial crisis and also during the 2008 financial crisis. They had used similar tools to basically improve the lending in the system and reduce risk aversion. So we should see the fruits of these measures play out in the next 3 to 6 months.
Okay, Rahul, just to get your summary views, as the finance minister has promised, there's more coming. What would you like to see targeted perhaps in the next set of measures? I'm surprised there weren't announcements on further cash transfers, because I think a lot of people have said that the cash transfers are grossly inadequate.
Well, again, I think it really depends on how much really they can do, and maybe the lack of announcements on cash transfers might have something to do with the strategy on the 4th phase of the lockdown itself. So if the government is allowing more areas to open up, then maybe there is no need to do multiple rounds of cash transfers. But I do think there will be some more fiscal support packages which will be given for the poor and the vulnerable. I think more than anything else, I was most excited by the idea of having some labor law, land reforms, and also legal changes, which the Prime Minister promised yesterday in his speech. So, that those kind of factor market reforms, particularly at the state level, and also state financing changes, possibly, given how stretched the state financing situation is right now, does that lead to some kind of a reform momentum on the GST front? Could become become a self-fulfilling prophecy in some sense, that we do see the GST getting simplified, but possibly with a higher rate of revenue neutral rates. That could be a very, very punchy reform over the next 3 to 6 months.
Okay. Abizer, apart from what has been announced on the financial system so far, what do you think is imperative to be done? Will we have you back here and talk about a bad bank finally, or will we not?
Oh, so bad bank, I think, is a requirement. I've always maintained that 2 years earlier, and now too, because of just 2 reasons. I think we need it. One is because we need to aggregate exposures, and the other is, frankly, we need the right skill sets to manage it. So if you're going to have the same people manage it, it won't work, even if you aggregate exposures, is my view. But that's on the bank, bad bank. But I think more than that, one of the things that we need to deal with in the financial sector is actually compounding. So one of the things I was hoping, and maybe I hope to see in future, is a waiver of interest. We've seen schemes which talk about moratoriums, but think about an NBFC or a bank or an MSME. Their ability to pay catch-up interest is almost not there. Frankly, I think a moratorium would help. A waiver of interest would certainly help. And if there is a scheme which comes up to that, I think that will be useful. What we are doing today is we're still trying to maintain the interest recoverability. Another important thing I'm looking for is a one-time restructuring scheme. And I think that is absolute necessary, otherwise we'll create a crisis. We are going to see a lot more companies come up. And I have a simple view on this. Instead of the schemes today, which basically say if you restructure, you get classified as an NPA. The problem being classified as an NPA is you avail of no other finances. So idea is that you avail of a restructuring, but give them 2 years to prove that the restructuring works. If it doesn't, then you retroactively classify them as NPA. But give them relief today for 2 years on an agreed restructuring.
I think we've lost Abizer's line there. I'll try and go to Mahesh. And Abizer, sorry, we are back. You were at the point where you were saying that you think a one-time restructuring is needed.
Yeah, so I think one-time restructuring is required, and I just want the NPA to be back-ended instead of front-ended, the NPA classification. So if you do a restructuring today, an account is classified as an NPA right now until it proves performance in 2 years. I would rather turn it around, that allow them 2 years as a non-NPA. If they don't perform in 2 years, then classify them as an NPA with retrospective effect. So I do think that if you allow a one-time restructuring with a consequence, it will work. And that's what the government should focus on.
Okay. Mahesh, last word to you. Any suggestions on the, again, NBFC, HFC sector that you think are required, or any sort of suggestions to ensure that some of these guarantee schemes that we are announcing, we get the maximum bang for the buck from them?
Yeah, so I think operationally managing these guarantee schemes is very important. Otherwise, we will end up with a mess far greater than what we have seen in the past. I hope for some stronger fiscal measures which will give people cash, because it's very important to get demand back. Because we have to keep in mind that the COVID has hit us at a time when we were already slowing down. And specifically in housing, unless the demand comes back and the multiplier effects it has on numerous components of the GDP, and the social impact that promoting housing does have, I'm hoping for stronger fiscal measures which puts cash with people and we see demand coming back. It won't come back in less than 6 months, but at least after 6 months.
I'm sure Rahul agrees with that as well. I'll wrap up this conversation, a quick one to take care of the announcements made today. Thank you all so much, Rahul, Abizer, Mahesh. Appreciate you joining us on short notice. And do stay tuned to BloombergQuint.com. Go to the website, lots more on.
Thank you.
How many places can you be at once? What if we said 9? BloombergQuint Live. We are everywhere.